The most consequential financial shifts rarely arrive through announcements. They surface through absence, a trade not renewed, a hedge quietly removed, a balance sheet allowed to breathe in a new direction. Institutions that sit at the center of the system do not explain these moves publicly, because explanation is not their function. Their convictions appear elsewhere, embedded in funding choices, derivatives exposure, and the tolerance limits quietly approved inside risk committees. This documentary begins from that premise. What matters is not what was said, but what changed. The phrase insider leak is therefore misleading. Nothing here relies on rumor, whistleblowers, or privileged conversations. The signal examined is structural. It is visible in posture and duration, in how uncertainty is priced internally rather than how confidence is performed externally. History provides context for reading such signals. In the late 1920s, major banking houses reduced exposure to speculative credit well before public optimism collapsed. In the early 1970s, global institutions quietly prepared for a monetary order that no longer held gold at its center. In the late 1990s, risk was redistributed through balance sheet engineering long before equity markets recognized fragility. Each episode followed the same pattern. Positioning shifted first. Language followed later. The public narrative lagged because it always does. Institutions closest to liquidity plumbing adjust not because they foresee collapse, but because they feel constraint. They respond to friction before it becomes visible to price. It is in this context that the phrase, flip long, must be understood. This is not a retail expression of optimism. It describes a structural decision to extend time horizons, accept duration risk, and privilege certain forms of collateral over others. It reflects choices about liquidity preference, sovereign exposure, and the willingness to absorb volatility rather than avoid it. Until recently, one institution defended the assumptions of stability more consistently than any other. J.P. Morgan operated as if continuity, depth, and resilience of the existing system could be taken as givens. Its public posture emphasized prudence, balance, and caution toward directional conviction. What has changed is not a headline, but a deviation. Internal assumptions appear to have shifted away from neutrality. This does not announce itself through press releases or forecasts. It becomes legible only when posture no longer matches prior behavior. When a system's most embedded participant begins to realign, the signal is not emotional. It is informational. It encourages pattern recognition rather than prediction. Viewers are invited to watch behavior, not commentary, and to treat exposure as evidence. No trades need to be named for the signal to register. When duration lengthens, when liquidity is deployed instead of preserved, a message is being transmitted regardless of intent. That message is always contextual, emerging from comparison with prior posture rather than absolute position across time and cycles of the system. The unease this creates is intellectual. If an institution designed to benefit from stability adjusts as though stability can no longer be assumed, then the risk lies not in movement, but in stillness. The question is not what was discovered, but what ceased to hold. This documentary begins by asking a single question. What changed beneath the system that made remaining neutral or defensive more dangerous than committing early? Everything that follows is an attempt to answer that quietly, without speculation and without drama. In public markets, the word long is usually understood as a simple directional bet. At the institutional level, that definition is incomplete. For systemically important banks, being long is not about enthusiasm for price appreciation. It is about extending time horizons, accepting exposure that cannot be exited quickly, and expressing confidence in the durability of underlying collateral. Institutions do not declare this posture through outright purchases alone. They express it through structure. Duration is lengthened in funding profiles. Balance sheets are permitted to carry assets whose value depends on continuity rather than liquidity. Derivatives are repositioned so that volatility is absorbed instead of hedged away. Internal risk weights are adjusted to reflect belief that certain exposures are survivable across cycles, not merely tradable within them. Even liquidity buffers are reinterpreted, shifting from immediate flexibility toward resilience over time. Capital allocation priorities reveal more than public commentary ever could. When a bank is genuinely long, it commits scarce balance sheet capacity. It allows positions to mature rather than insisting on optionality. It reallocates capital toward areas where exit costs are high but strategic relevance is durable. These decisions are approved quietly, often framed as prudence rather than conviction, yet they alter institutional behavior for years and shape how risk is distributed internally across divisions. History clarifies this distinction. In the early 2000s, institutions that were long housing were not simply purchasing mortgage assets. They redesigned leverage models, accepted thinner capital buffers, and embedded real estate assumptions into their funding structures. The exposure was systemic, not tactical. In the 1970s, being long inflation did not mean predicting prices. It meant abandoning faith in fixed income certainty and reorganizing portfolios around assets that could endure monetary erosion. In each case, the choice to flip long reflected a judgment about risk asymmetry. Waiting carried greater danger than acting. Remaining neutral meant exposure without preparation. Commitment, even with uncertainty, offered control. This is why flipping long should not be mistaken for optimism. It is a response to constraint, not confidence, and it is usually uncomfortable at the moment it occurs. For institutions embedded at the core of the dollar system, such shifts are rare. Stability is their comparative advantage. They benefit from depth, liquidity, and predictable correlations. Directional exposure undermines those advantages and invites scrutiny. As a result, these banks typically resist posture changes until neutrality itself becomes a liability, forcing decisions that were previously deferred. When an institution like J.P. Morgan adjusts its internal assumptions, the implication is not cyclical repositioning. It suggests that the conditions supporting passivity have eroded. Something structural has changed in how liquidity behaves, how assets are trusted, or how time itself is priced. This section does not yet identify the source of that pressure. It establishes only the meaning of the response. Understanding what flipping long entails at this level prepares us to examine why remaining uncommitted may no longer be viable under current global conditions for institutions globally. History shows that when core financial institutions change posture, they do so quietly and early. These shifts rarely resemble warnings. At the time, they appear mundane, technical, or even confident. Only later are they recognized as defensive adaptations to constraints that were already forming beneath the surface. The first clear example emerges in the late 1920s. In the years preceding the Great Depression, major banking houses began withdrawing from speculative credit and shortening certain exposures well before equity markets collapsed. This behavior was not framed as fear. It was described as prudence, balance, and modernization. Yet capital was being repositioned away from fragility toward assets and structures perceived as more durable. The collapse that followed did not cause the shift. It revealed why the shift had occurred. A similar pattern appeared during the erosion of the Bretton Woods system. By the late 1960s, global institutions with exposure to trade settlement and sovereign reserves began acting as though the gold-backed order was unsustainable. They adjusted balance sheets, diversified reserve assumptions, and prepared for monetary flexibility years before formal convertibility ended. At the time, these moves were interpreted as technical evolution within a stable framework. In retrospect, they marked the quiet recognition that the existing anchor could no longer support growing scale. The third case unfolded before the 2008 financial crisis. Core institutions did not abandon risk wholesale. Instead, they reallocated it. Capital flowed into instruments designed to simulate safety through structure rather than substance. This reallocation was celebrated as innovation. It was understood as efficiency. Only after systemic failure did it become clear that these moves reflected an attempt to manage mounting constraints within the system's plumbing. Across these episodes, the logic is consistent. Institutions closest to settlement, funding, and cross-border flows experience friction first. They see mismatches between promises and capacity before those mismatches register in prices. Their response is not to predict collapse, but to adapt to narrowing margins of error. This process does not require conspiracy or privileged foresight. Incentives alone are sufficient. Banks operating across sovereign debt, trade finance, and currency markets observe stress propagation in real time. When liquidity becomes conditional, when collateral quality fragments, or when settlement reliability weakens, those institutions adjust exposure as a matter of survival. Their posture changes reflect an acceptance that prior assumptions no longer scale. These shifts are often misread because they are subtle. They are framed as routine adjustments, improvements, or strategic refinements. Language lags behavior. By the time public narratives change, positioning has already moved. Understanding this pattern matters because it reframes the present moment. What appears novel or alarming fits within a long tradition of systemic transition. The current shift follows the same historical logic, but with a notable distinction. In earlier episodes, institutions adapted around the anchor of the system. This time, the anchor itself is being quietly reassessed. Pressure does not arrive as an event. It accumulates as friction, narrowing the range of choices available to large institutions until previously neutral positions become untenable. The present environment confronting global capital is defined less by crisis than by constraint. Liquidity, once assumed to be deep and continuous, has fragmented. Capital still exists, but it no longer circulates with uniform speed or reliability. Regional funding conditions diverge. Collateral that clears easily in one jurisdiction carries delay or discount in another. For institutions operating across borders, this fragmentation introduces latency into decisions that once relied on immediacy. At the same time, sovereign debt saturation alters time preference. When public balance sheets expand beyond growth capacity, the future becomes more heavily encumbered. Long-term promises lose clarity, and rollover risk becomes structural rather than episodic. Institutions respond by reassessing how long assets can be held without relying on stable refinancing assumptions. Policy credibility has also thinned. Monetary and fiscal tools still function, but their predictability has declined. Repeated intervention compresses confidence even when it suppresses volatility temporarily. The result is not panic, but skepticism. Markets no longer assume that policy responses will restore prior conditions. They assume instead that responses will manage decline or delay adjustment. Traditional hedges reflect this change. Instruments designed to offset risk under stable correlations lose effectiveness when correlations themselves become unstable. Volatility, rather than being a transient signal, becomes a recurring expense. Managing it requires capital, margin, and attention. Flexibility, once protective, now carries a measurable cost. In this environment, remaining short duration or excessively defensive is no longer neutral. It exposes institutions to erosion through misalignment with emerging structures. Holding optionality sounds prudent, but when conditions shift continuously, optionality decays. The risk is not loss from action, but loss from drift. Committing earlier, even without full clarity, becomes a form of defense. It allows exposure to be shaped deliberately rather than accumulated passively. It converts uncertainty into managed positioning. This is the context in which flipping long must be understood. The decision does not reflect optimism about growth or resolution. It reflects recognition that the system no longer rewards waiting. Constraint has replaced stability as the dominant condition. The choice, therefore, is not between caution and conviction. It is between controlled exposure and unmanaged exposure. That pressure, rather than confidence, is what forces the decision. From the inside, this pressure appears incremental. Models adjust, buffers tighten, and assumptions are revisited one by one. No single variable demands action. Instead, accumulation does. When multiple constraints operate simultaneously, the cost of maintaining neutrality compounds. Over time, institutions recognize that flexibility preserved for too long ceases to be flexibility at all, becoming exposure to conditions they no longer control. This recognition marks the transition point. Action becomes less about preference and more about necessity. The environment dictates timing. Institutions do not seek precision, they seek survivability within altered parameters. That is why the decision precedes explanation. The system applies pressure silently, and posture changes follow before narratives adapt. It is this narrowing field of acceptable outcomes that ultimately forces commitment. Not because clarity has arrived, but because delay itself has become a position, and an increasingly risky one under present conditions. Only at this point does it become useful to narrow the field. The shift under examination does not point toward individual trades or short-term opportunities. It points toward categories of exposure that remain coherent when abstract liquidity becomes less reliable and credibility migrates toward tangible structures. The first category is real assets. Historically, when financial claims expand faster than productive capacity, capital seeks anchors. Real assets serve that function not because they guarantee returns, but because they impose physical limits. They cannot be replicated through leverage alone. Their value is constrained by extraction, production, or use. In periods of transition, this constraint matters more than price behavior. It restores a reference point when valuation frameworks become crowded with competing promises. A second category involves duration hedges. When stability gives way to recurring volatility, time itself becomes a variable to manage. Duration hedges are not bets on interest rates. They are tools for absorbing uncertainty over longer horizons. Institutions that extend duration accept interim fluctuation in exchange for continuity. This posture reflects a belief that oscillation is persistent, not temporary, and that protection lies in structure rather than timing. Selective sovereign exposure forms a third category. Fragmentation does not affect all states equally. Some jurisdictions gain leverage when systems decentralize, particularly those positioned to intermediate trade, resources, or settlement flows between competing blocks. Exposure here is not ideological, it is logistical. Capital follows environments where rules are enforceable, infrastructure is usable, and external alignment enhances rather than constrains autonomy. The fourth category centers on infrastructure tied to trade rerouting. As supply chains regionalize, the pathways themselves acquire strategic value. Ports, transport corridors, energy systems, and digital settlement rails become instruments of power. Investment in these structures reflects recognition that movement, not abstraction, governs economic continuity. Infrastructure endures because it cannot be relocated easily, and because its relevance increases when redundancy replaces efficiency. None of these categories promise certainty. That is not their purpose. They absorb institutional capital because they align with how credibility shifts during systemic transitions. When trust in generalized liquidity thins, capital gravitates toward forms of exposure that are legible, enforceable, and anchored in jurisdiction or physical reality. This distinction is critical. The repositioning underway is not a search for yield. It is a search for reliability under altered conditions. Returns remain important, but they are secondary to coherence. Institutions allocate toward areas where assumptions can be defended internally over time, even if outcomes vary externally. Seen together, these categories form a pattern rather than a prediction. They reflect long-standing civilizational behavior. During periods when dominant systems reorganize, capital consistently moves toward tangibility and clarity. It favors assets and structures that can be understood without reliance on universal consensus. This coherence is what distinguishes strategic repositioning from opportunism. The shift does not chase novelty. It consolidates around forms of exposure that have historically absorbed pressure when abstract frameworks falter. Understanding this helps clarify what the repositioning is pointing toward, even as specifics remain deliberately undefined. Institutional repositioning almost always precedes public explanation. This is not because institutions possess secret foresight, but because the mechanisms that govern their decisions operate on a different clock. Risk committees respond to constraint, not narrative. They move when models register friction, because markets punish late adaptation far more consistently than they reward early certainty. Public communication lags for structural reasons. Internal models absorb granular data funding stress, collateral behavior, settlement delays, correlation breakdowns. These inputs do not translate cleanly into language suitable for public consumption. Explaining them would require revealing assumptions, vulnerabilities, and priorities that are not meant to be debated in real time. As a result, posture changes first, while language follows only when change becomes unavoidable. For systemically important institutions, transparency is further limited by function. They are not commentators, they are operators. Their role within the system requires stability, confidence, and continuity. Premature disclosure of internal concern would not clarify conditions, it would amplify uncertainty. Silence, therefore, is not deception. It is an operational requirement embedded in how large financial institutions maintain equilibrium. History reinforces this pattern. Inflation was described as transitory long after capital positioning suggested otherwise. Balance sheets adjusted before language did. Exposure shifted while explanations remained static. The public narrative changed only after behavior made denial costly. The same sequence appeared during the unraveling of globalization. Official rhetoric emphasized resilience and integration even as capital quietly rerouted supply chains, diversified settlement paths, and reduced dependence on singular hubs. In each case, observers who focused on statements missed the signal. Those who watched behavior understood earlier that assumptions were changing. This distinction is central to interpreting the present moment. The lag between posture and narrative is not an anomaly. It is a recurring feature of complex systems where action must precede consensus. This is why the notion of an insider leak is misleading. Nothing has been disclosed in the conventional sense. No document surfaced. No admission was made. What exists instead is behavioral disclosure. Exposure itself communicates information. When institutions adjust duration, reallocate capital, or accept forms of risk they previously avoided, they are revealing how conditions are being interpreted internally. Behavior cannot be smoothed by rhetoric. It reflects decisions already approved, capital already committed, and assumptions already revised. By the time these changes become visible, the internal debate has concluded. The narrative, when it arrives, serves to explain what has already occurred, not to guide it. Understanding this reframing is essential for avoiding sensationalism. The signal does not imply imminent crisis or hidden knowledge. It indicates adaptation to changing parameters. Institutions move quietly because their scale demands it. They cannot wait for consensus, nor can they afford to announce every adjustment. The audience is therefore invited to recalibrate how signals are read. Trusting observable behavior over stated belief does not require cynicism. It requires literacy in how systems function. When posture changes before language, it is not because the truth is concealed, but because action must precede explanation in environments where delay carries cost. This timing gap is not a flaw in the system. It is how the system maintains continuity while adjusting to pressure. Recognizing it allows the present shift to be interpreted with clarity rather than alarm, and prepares the ground for understanding what those adjustments ultimately signal. When a system's most embedded actors adjust posture, the implication is not panic but recalibration. Markets respond first through structure rather than sentiment. Volatility ceases to be episodic and becomes a standing condition. Price movement no longer signals surprise, It reflects ongoing negotiation over value in an environment where reference points are shifting. Safe assets, in this context, do not disappear. They become conditional. Their safety depends on jurisdiction, liquidity access, and political alignment rather than universal acceptance. Assets once treated as neutral collateral begin to carry qualifiers. This does not mean trust collapses. It means trust differentiates, and differentiation alters how capital is deployed and priced. Correlations weaken as a result. Relationships that held during periods of abundant liquidity lose reliability when liquidity fragments. Diversification behaves differently. Hedging strategies require revision. What once moved together begins to separate, not because markets are irrational, but because the structures linking them no longer operate uniformly. This environment favors those able to observe and adapt rather than those relying on static models. Policymakers encounter similar constraints. Tools designed for centralized systems operate less effectively when flows decentralize. Interventions still matter, but their reach shortens. Policy becomes one influence among many rather than an overriding force. This shift does not render governance irrelevant, but it does limit its capacity to restore previous conditions. Other institutions respond unevenly. Those built around passive assumptions struggle as benchmarks lose clarity. Strategies dependent on stable correlations, predictable liquidity, and uniform risk pricing experience friction. In contrast, active capital gains relative advantage. The ability to allocate selectively, reassess assumptions, and withdraw from eroding structures becomes a source of resilience. This distinction is structural, not moral. It reflects how different forms of capital interact with changing conditions. Passivity functions well when systems are stable and centralized. Activity becomes necessary when systems fragment and adapt. Neither approach is inherently superior. Their effectiveness depends on the environment they inhabit. Seen from this distance, the current shift appears less dramatic and more evolutionary. When institutions closest to system plumbing adjust, they do so to remain functional within altered parameters. Their adaptation signals that the system itself is evolving, not that it is failing. Continuity is preserved through change rather than through rigidity. For observers, the implication is not alarm, but awareness. Assumptions forged under one set of conditions cannot be carried forward unchanged. Risk, opportunity, and stability are being redefined in quieter ways than headlines suggest. Understanding this helps separate noise from signal. The broader system is not entering chaos. It is entering differentiation. Power, liquidity, and credibility redistribute incrementally. Those attuned to structure adjust early. Those anchored to prior norms experience increasing friction. This is the nature of systemic transition. This section prepares the ground for a concluding perspective. If adaptation is underway at the core, then the task is not prediction, but interpretation. Recognizing evolution as it occurs allows response without panic and engagement without illusion. That is the signal these shifts send across the broader system. It underscores adjustment as a process already in motion, not a future event. This documentary does not end with collapse, because collapse is rarely how complex systems conclude. Civilizational orders do not vanish overnight. They reorganize. They adjust boundaries, incentives, and assumptions. Capital does not disappear in these moments. It relocates, seeking environments where continuity can be preserved under new conditions. History supports this interpretation. When older frameworks strain under scale or complexity, the response is not sudden failure but gradual reconfiguration. Power disperses. Liquidity reroutes. Authority fragments and reforms elsewhere. What feels like instability from within the old system often registers as opportunity from the perspective of the new one taking shape. Understanding this distinction matters. Transitions punish rigidity, not participation. Those who assume continuity without adjustment experience friction, not because they are wrong in principle, but because the operating conditions have changed. Assumptions that once reduced risk begin to amplify it when carried forward unchanged. Those who adapt early do not do so because they possess certainty. They adapt because they observe structure. They recognize when incentives shift, when trust differentiates, and when time itself is repriced. Their advantage lies not in prediction, but in responsiveness. They move with change rather than waiting for validation. This documentary has deliberately avoided prescriptions. It does not instruct the viewer what to buy, sell, or fear. That would misunderstand the nature of the signal being examined. The repositioning described at the beginning is not a forecast. It is a marker. It indicates that the environment in which decisions are made has already altered. Interpreting such markers requires restraint. It means resisting the urge to dramatize adjustment as decline. It means recognizing that systems preserve themselves through evolution, not denial. The danger does not lie in change itself, but in refusing to acknowledge it. The quiet shifts examined throughout this film reflect changing operating conditions. Liquidity behaves differently. Risk is distributed differently. Stability is conditional rather than assumed. None of this implies imminent failure. It implies adaptation underway. This perspective reframes unease as information rather than threat. The discomfort many sense does not arise from chaos, but from transition. Old reference points fade before new ones fully establish themselves. During that interval, clarity is reduced, but direction is present. The documentary ends where it began, with pattern rather than prophecy. Across history, the earliest signs of systemic change appear where capital is most concentrated and least emotional. Balance sheets adjust before beliefs. Exposure shifts before explanation. These signals do not announce endings, they reveal movement. The system viewed from this distance is not breaking, it is shifting. That shift is uneven, incomplete, and ongoing. Understanding it does not require alarm, only literacy. Those who read structure rather than rhetoric recognize transition for what it is, a process already in motion, reshaping conditions quietly and continuously. In that recognition lies the purpose of this examination, not to provoke fear and not to offer certainty, but to restore perspective. Systems endure by changing. Capital adapts by relocating, and history moves forward not through collapse, but through reconfiguration.